Welcome back to the Lance Roberts Show podcast right here at realinvestmentadvice.com. We're speaking with Daniel Ruiz today. Blindersoffresearch.com is his website. Daniel, just for the break, we were talking about extending these auto loans for a long period of time, 0% interest rates. And this was to allow affordability. It allowed for automakers to keep prices high on automobiles while still affording lower payments to individuals. One of the side effects of the previous administration, coming out of the financial crisis, we were trying to do everything we could to get the economy kind of back on its feet. And one of the things that the previous administration thought would be a good idea was a move called Cash For Clunkers, where it basically took used cars off the market, made used cars very expensive relative to new cars. We're now seeing the problem of a lot of used cars that are coming off of lease and other types of programs that are now starting to challenge prices for new cars. What was the consequence of doing things like Cash For Clunkers on the automobile sector and its cycle?
Cash For Clunkers was very effective in sort of stabilizing the automotive industry when it was in a downward spiral during the Great Recession. We need to look at it like just like any other commodity, right? So it is subject to the laws of supply and demand, just like any other commodity, any other asset. And sales had been declining for years heading into the recession, right? So we need to look at new car sales as future used vehicle supply, right? Because that's how used car supply is born, is when the vehicle is sold. So after so many years of declining, the supply started coming down. And then the government decided to stimulate autos even more by creating Cash For Clunkers. So as values are concerned, I really, really look at used car values as a critical point to measure when it comes to consumer purchasing power of autos, because they're such a big part of the transaction. New vehicle sales are so incredibly reliant on replacement cycles, which we'll get into in just a bit. But in essence, what Cash For Clunkers did was increase consumer purchasing power, because these clunkers were getting a big boost in value for the consumer, and they had to purchase new vehicles in order to get the rebate, or the incentive, I should say. But the other thing it did was those cars, when they were traded, never came back to the used car market. So we're already in a situation where used car supply is being drawn down significantly by the collapse in new car sales. And then all of a sudden, all of these trades that come in, which stimulate new vehicle sales, are disposed of. They're destroyed, which further brought down used vehicle supply. So you can literally see when you look at used car values, they just went parabolic right after the recession, because we created a situation where supply was greatly, greatly reduced in the used car wholesale market, and it stimulated new vehicle sales. So yeah, it was literally just a straight up situation in terms of used car values.
Is that being reversed today, though?
Yes. One of the effects that used car values have when they were coming out of that Great Recession so high is automakers were setting their residual values very closely to how used cars were performing, which led to really, really low car payments on new vehicles. Leasing represents about 30% of the transaction volume in new car sales, as far as retail is concerned. That number kept growing. Well, guess what? At some point in time, those vehicles come back. And 2019 is the peak in lease maturities. So there's the potential for more used vehicle supply to come back online. There's a lot of intricacy, because maturities don't necessarily become supply unless the used car value falls below the contracted residual from 3 years prior. Retail dealers set pricing on used cars. What I keep an eye on is how used car retail inventory levels are fluctuating. When they increase, then demand from dealers at wholesale auctions decrease, because dealers are in essence going to auctions to replace vehicles that they've sold. So if the supply at the retail level is increasing, that means that there's going to be less demand at wholesale auctions and values will fall. The opposite happens when inventories decline. Then you can expect for dealers to go to the auction in greater numbers, increase demand, and increase pricing. And we've had a couple of very, very tricky years because in 2017, we had a secondary bump in used car values because of the hurricanes. In 2018, we had a secondary bump in used car values because for the first time in 54 months, new vehicle automakers reduced incentive spending. So we haven't had a normal depreciating curve in 2 years, and I think that's about to change.
So, that's a great comment about the issues of, used car sales. That's something I watch in particular because I think the used car market, it gives people a choice. If the cost of a used car that's 1 or 2 years old is a better deal than buying a brand new car off the lot because of the depreciation issue, that provides choice to consumers. And of course, that also can potentially crimp new car sales. So I like that point, but I think one of the issues, and I want to come back after this break and talk about the issue of equity and interest rates and used versus new car sales, particularly as it relates to equity in the car, the time to equity. When we come back from the break, I want to pick up with Daniel Ruiz on that issue, blindersoffresearch.com. When we come back, more with Daniel Ruiz. Don't go away.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.